Hi, George.
John, how are you?
Doing well, how are you?
Well, thank you.
So to start off, why don't you introduce yourself and the team that supports the strategy?
I'm George Sakalaris. I've had the pleasure of managing the mid-cap growth strategy since I joined Brown Advisory in 2014. Together with Chris Barrier, we run the mid-cap growth and the small-cap growth strategies together as one franchise. Emmy Wachmeister joined the team in 2021 as Associate Portfolio Manager after covering small-cap software companies for about a decade with us for both strategies. We're supported by a much larger team of about 50 people in total, about a dozen of which focus down on the smaller companies, small cap growth and mid cap growth. We have sector specialists, 3 to 4 people in each economic sector, and generally about 1 or 2 of those individuals tend to spend more of their time down cap, and 1 or 2 of those individuals tend to spend more of their time up cap for our large cap strategies.
Provide a brief overview of the strategy's investment philosophy.
So our goal is to generate superior risk-adjusted returns over a full market cycle, which is typically 3 to 5 years for us. And what that means in regular terms is that we're trying to outperform the benchmark by about a point or 2 with a lower volatility profile over a full market cycle. And we do that by owning about 60 to 65 small and mid-cap companies that we think one day could be much larger. We call those compounders. We think that by owning companies that express certain traits that I'll detail and owning them at reasonable prices and holding them for years, we can produce superior risk-adjusted returns over a long time period. And so what we do is we find compounders, we buy them at reasonable prices and own them for years as things go right, and typically that leads to superior returns over a long period of time.
Can you share a little more detail on the strategy's investment process?
So we have a set of characteristics that we look for that we call the 3 Gs. That stands for durable growth, sound governance, and scalable go-to-market strategies. These are traits that we look for through our 3-step process that we think give a company a better chance of being one of those compounders, a company that could grow and grow and grow consistently and durably for many years and build shareholder value over a long period of time. From a durable growth perspective, we're looking for companies that address large and growing markets, that have a demonstrable ability to gain share profitably. We find that when you get the confluence of those 2 traits, growth tends to stay stronger for longer, so we're a little bit more focused on the durability of that growth rather than the absolute level. Sound governance. It's our analysis of the people that are going to tackle the opportunity that the first G presents. So we're looking to invest behind management teams that we trust, that are transparent, that we think have the right strategy to grow a company occasionally from small to mid to even large a couple of times when we're lucky enough to have something compound for that long. Of course, we're looking for other things such as the right incentive schemes, appropriate board structures, and things like that. But when it comes down to it, it's trustworthy and transparent management teams that can tackle that opportunity that the first G presents. Scalability, scalable go-to-market strategies, the 3rd G, is really all about producing a durably high or improving return on capital over our 3 to 5 year typical investment time horizon. We look for those companies through a 3-step process. So that consists of idea generation, due diligence, and then portfolio construction. Idea generation for us is purposefully labor intensive. We have about 2,500 companies for both strategies that span the market cap range of about 0.5 billion to 50 billion in market cap. Typically, we do this by interviewing 400 to 500 companies a year. That's why we need a dozen people focused on these 2 strategies. We do not use quantitative screening methodologies on purpose because they're typically not forward-looking, and as you move down cap, a lot of the data is missing. And so we find that in order to be entirely fundamental and entirely forward-looking, it's best if we simply roll up our sleeves and do primary research on hundreds of companies a year for the sake of idea generation. From idea generation, assuming something has a high likelihood of fitting the 3G profile, we then move into due diligence, which consists of a number of primary company interviews, a lot of quantitative work, modeling, forecasts, things like that, finding the key metrics that could yield success over our typical 3 to 5 year investment time horizon, and then putting those to the test by interviewing customers, competitors, suppliers, vendors, what we refer to as secondary sources. From that work, comes a number of structural elements like an initiation debate and things of that nature, a lot of valuation work at the end of that process, and that then leads to portfolio construction, which is the end product that you see. So that consists of position sizing, consists of risk monitoring at the portfolio level, consists of sell discipline and self-improvement.
What are some of the strategy's differentiating characteristics?
So there are a few. I think it starts with the firm overall, which is a differentiating characteristic for all of our strategies. Our firm is privately held and has a partnership culture that both of which enable us to be truly long-term focused. Then it gets down to our team. So we have a team of about 50 people, and if you don't have the right people in the right spots, this is really hard to do. So our team over many years has grown as our resources have grown, and I think we've done a really good job of recruiting the right people to be in the right spots. For the strategy specifically, I think mid-cap growth benefits from its small-cap heritage. Both Chris and I have been analysts or portfolio managers for small or mid-cap strategies for 22 years apiece, so there's experience there. Our focus on management quality comes from that small-cap heritage. You have to make sure that you have the right people in the right spots as you move down the market cap spectrum. In addition to those elements, I think we have some subtle systematic elements. So things in our process that help us, things in our portfolio construction and in our self-reflection that differentiate the strategy. So our process is very systematic, and we've honed a lot of templates and process elements over the year to help that, both in breadth and depth, and to make it more systematic over time. We have an element of our philosophy we often don't talk about, where we're looking for positive change at the margin. That is a sort of hidden element that makes a quality growth approach a little different than you might see at some of our competitors or some peer strategies. We're looking for companies not only to demonstrate those 3G traits, but have some element within their fundamentals that give us confidence that those 3G traits could persist longer than people think, or just surprisingly exist or improve over our typical 3 to 5 year time horizon. We also leave valuation to the end of our process, which we think is also a subtle differentiator that helps us avoid 1 or 2 more value traps or broken growth stories each year, hopefully. And then I'd say at the end of our process, our systematic sell discipline and our self-reflection give us subtle differentiators in a competitive market.
Discuss your approach to portfolio construction, and what are some typical attributes of the portfolio?
So the portfolio at a high level is best described, as we mentioned, as a quality growth approach. Typically, we hold about 60 to 65 positions. The largest position size would be about 5%. It has exposure across sectors, because what we're trying to do is let the team's stock selection shine through, as opposed to some massive lucky sector bet at the right time. We're not macroeconomists, we're bottom-up fundamental analysts and stock pickers at heart. So know that it has proper diversification across sectors. The portfolio typically exhibits lower volatility than its primary benchmark, the Russell Midcap Growth Index. It typically has relatively high active share, which for us is about 75 to 85% in the mid-cap growth category. It tends to have much higher quality companies, as you might imagine, given our philosophy, that are built through that detailed fundamental bottom-up process. And it typically has, even though it's all bottom-up and sort of a best ideas approach, it typically on purpose has exposures across sectors so that we can let the stock selection of the team shine and drive outperformance over a long period of time, as opposed to a factor or sector bet.
How do you expect the strategy to perform in different market environments?
So generally, given that quality growth approach and the portfolio's diversification, it has a chance of outperforming in most market environments, or in all market environments. There are sometimes some short periods where we will face headwinds, and unless our stock selection in those short periods is good enough to overcome them, we will tend to lag. And those are really twofold. When there's a momentum growth driven sort of blow off top in the market, where growth at any price reigns and drives all returns, will typically lag because of our valuation sensitivity and our quality focus, as opposed to pure growth focus. And then on the flip side, we tend to find less cyclical businesses. That's a hallmark of a quality growth approach. And so in an early cycle trade where heavy cyclicals drive most of the market returns for 3, 6, 9 months, we'll typically face a headwind then.
So bringing it all together, why invest in the mid-cap growth strategy?
Well, two major reasons. One starts with the category. So mid-caps tend to produce really attractive risk-adjusted returns. And I can only speculate as to why that's been historically, but it's probably due to the quality of company and a sweet spot in their life cycle. So as companies grow into the mid-cap range, they tend to have the same market opportunities and growth profiles that they did when they were private or in the small cap range, but they have other more positive attributes like more professional management teams, better board structures, better systems to manage everything in place, things of that nature that give them a leg up versus when they were small caps. And you usually have fewer competitors by the time a company has evolved to that size. And then there's our strategy. So we've been able to produce attractive returns relative to our benchmark since inception with a lower volatility profile. And I think that from a portfolio construction and process perspective, there are some subtle differentiators that we've spoken about that give us a leg up over a long period of time.
So in closing, tell us one thing that people might not know about you as an investor.
So I've had over 20 years of experience analyzing and investing in small and mid-cap companies, and I've learned a lot over that time period. But I would say the most unique thing is that I didn't start in this industry. I was a physiology, neurobiology major in college in the 90s, and after that I worked for a Defense Department funded genetics lab. And so I was a scientist in a former life. And I think you can see aspects of that woven throughout our process. If you think about it, the scientific method has a very simple dogma: hypothesize, test, hypothesize, test. And you can kind of see that in the way that we go about diligencing a company. We hypothesize in the idea generation phase in the early parts of due diligence as we're forming our forecasts from primary sources, and we identify key metrics that we can monitor and test over time. They're unique to each company. And as we monitor and test those things using secondary sources in the diligence process, and over time as the company reports their results, that's how we test our investment hypothesis. So I would say that might be the one unique aspect that people might not realize.